In this video, I'm going to explain the ATR Trailing Stop Indicator, the average true range trailing stop, step by step from the perspective of a professional trader. So if you're trying to understand how to properly use that ATR Trailing Stop in your trading, why it's important, and how it can help you become a better trader, then this is the video for you. Now, if you don't have the time to watch the whole video and rather get our cheat sheet explaining the most important things when it comes to that ATR Trailing Stop Indicator, you can click the button that should pop up in the corner of this video or go to the link I have in the description. My name is Charles Moon, and I've been trading for close to 20 years, and today I'm going to teach you how the real professionals on Wall Street use that ATR Trailing Stop Indicator, the average true range, to potentially find big profits in the market. Don't forget to hit that like button nearby and subscribe to our channel if you want to learn more about stock trading and our favorite trading strategies. Let's dive in. So let's start with the basics. What is a trailing stop? Well, stops in general are known as safeguards, right? There's different ways of utilizing them. One is to really just kind of define your maximum risk on each individual trade. But the trailing stop has a duality in terms of purposes, right? One is to define the risk in your trade, but it's also used to minimize the risk exposure. So, for example, if the stock does start to rise, your stop will automatically bump up with it. In relation, as it's moving back up, if you're a buyer, the stop moving up is actually starting to whittle down your risk exposure. If the stop ends up above your entry, like say you're long on Tesla at whatever, $100, for example, and the stop's now at 101, you basically have $1 in profit locked in. And as the stock continues to ascend, the stop will also move in accordance. So it's doing several purposes here, right? Obviously, you're defining your risk, and then the automation of that trailing stop, you are mitigating your risk. And even if you're manually adjusting it, if that stop does go above your entry, now you're starting to lock in profits. You're putting yourself in a position of power. You know, one of the things that people have struggled with, especially newer traders, is not locking in profits. Usually means that they just don't know, or maybe they do get too greedy. And B, they're always afraid of missing the big move, so they're willing to let the stock really come back against them in anticipation, or in this instance, someone that doesn't know any better, maybe hope that it'll come back in their favor. And that's, something that we, as professional traders kind of just don't want to be married to. We just don't want to be married to one individual name. There's so many stocks that move on a daily basis. There's plenty of opportunities presented. We always forget, like we think that we're going to get rich off of one trade, and it's really not. It's a total collective body of work. So the trailing stop is going to be an asset, a tool that you could utilize to take emotions out of the situation, and really B, to take the greed out of the situation and put yourself in a position of power or a position of success. Now, let's explain what an ATR is first. ATR is a separate indicator, but the one that we're using is known as an ATR trailing stop. But I need to explain what ATR is first. So ATR stands for average true range. Now, there's different time frames that you could build it out. As you can see down here, I actually have mine over a 30 period, and I utilize it on a simple close. So basically it's just taking it from the close, but the ATR doesn't really care about the close. The focal point of the ATR is the extreme high and the extreme low of every single individual day. What it's doing is taking the total range. The total range is the highest price to the lowest price that the stock trades. So this ATR in my on my chart here is set at a 30 period. Now, because the chart time frame is on the daily, what that ATR average is, the average is going to be based on the total move the stock made or has made over the last 30 days. So this is important because now we know what the stock will normally move up and down in recent trading sessions. So when we see stocks expand beyond their ATR average, it's usually because something dynamic is happening, right? News, maybe, a breakout play, fundamental market activity. There's plenty of different reasons why a stock could really move beyond their ATR. But ultimately, when that happens, there's two things as a trader you must be aware of. Number one, there's a lot more money generally associated with the stock than there normally is, meaning the volume has kicked up a notch. There's a lot more institutional retail money coming in that is driving it beyond its moving averages. And B, when we see that expansion, it actually means that there could be breakout plays, potential short squeezes, potential buy squeezes if it's going down. But ultimately, something dynamic is happening. And when a stock is moving at a dynamic rate, the potential of pricing movement expands greatly. This is where we could see stocks that normally trade in $3 ranges, trade in $6, $10 ranges, and ultimately that leads to big opportunity. The beauty of that as well is that this big opportunity, in terms of return, won't happen over a month's period, but really happening in a matter of hours in certain instances, maybe even minutes. And some people don't like having that exposure, right, of their money in the market environment for over 30 days. Some people really want to get it in, get it out. Well, this is a good way of seeing when there's, dynamic opportunities being presented, when a greater than normal move could come into play, which means that you can make some pretty good profits in a very short period of time. So that's going to be super crucial here in the near term, that we recognize, more importantly, what the stock ATR average has been. Now, when we talk about the importance of this, again, when we see a stock not moving like they normally do, there's something taking place. When something takes place in a stock, there's such a different element that comes into play. One thing in particular is that we could see something known as a short squeeze. Short squeeze is basically when the market gets very, very one-sided. Ultimately, guys and gals, when we look at what a short squeeze is, we always anticipate it moving up, and it moves up at a great degree. There was a recent stock that moved from $10 to $17. It was Lucid. It was based on a rumor, and their ATR at the time was very small. It was less than, I think it was like around 50 cents. And of course, a $7 move came in. So imagine the leverage that you could get with the stock that normally isn't volatile, right? Going from $10 to $17, and all of that taking place in an hour. Well, in terms of the option market, this is a situation where options that were extremely cheap, right? We're talking about 10, 15, 20 cents per contract are all of a sudden trading at $2, $3, $4, $5 in a very short period of time. The ability to leverage a stock that's $10, right? You could buy a lot more of a $10 stock than, let's say, a stock like Apple that could trade anywhere from $80 to $100, right? If it's trading at $100, that means you're getting 10 times as many stocks as you normally would if you were to buy Apple. So imagine that leverage and getting the same type of move as a stock like Apple and Tesla. This is extremely important because when we recognize that the market is getting one-sided, that is now leading to something dynamic. It is leading to opportunity. It is leading to huge profit potential in a short period of time. And some people don't recognize this, but one of the earliest ways you can pick that up is when a stock is now trading greater than the ATR. Now, so if we look at the ATR, folks, right? And the way we can recognize it is if that ATR, for example, is 50 cents, right? And all of a sudden we look at the day's range and it's $11 to $10. Well, obviously, we now know that we are double what the ATR is. So on screen right now, we have BIDU, okay? So if we look down here at BIDU, their ATR is currently at 5.82. So that means on average, BIDU moves $5.82 a day from high to low, okay? So high to low. Well, today, so far, the total range, you could just actually see it right here where it says R, right up here. Sorry, I'm trying to draw with this on this desktop. It's $9.86 today. So we have expanded beyond the ATR by $4. Early on, you could see that it jumped. We traded initially at the lows of 145 and immediately ran up to 154.86. Just a huge move on news. Today, I believe that they had news that BlackRock took an investment in the company. Yesterday, they had news that they were working on some AI project and development. All of this has led to, obviously, a high level of demand. But now, if we actually kind of combine that with the short thesis, well, you know, BIDU was getting knocked back over the last 2 days. BIDU went back down from 142 down to 132 in 2 days. So as you could see, it jumped to 145. We got up from where it actually started to roll over to the downside. We were above that level by $3. So short sellers, recognizing that they're in a bad position, knew that they had to liquidate at the open. And then the buyers are like, well, look at where it's opening. There's huge potential because there's a lot of room to the upside. If you notice from where this moment is to the purple lines here, there is a lot of space. And so the short sellers recognize that moment. They decided to exit. Buyers recognized the opportunity. They decided to come in. And this is what I mean by the market getting one-sided. When short sellers, or if you are short, you need to cover your position or exit position, you have to buy back your position. So if you're short, to exit, you have to be a buyer. If buyers want to get in immediately, what do? They have to buy the market price, whatever the current market price is. So as you can see, at that moment at the open at 145, everybody raced in on the buy side. And next thing you know, the stock is trading above 150 and as high as 154. That was very important. Once it crossed 150, right, that basically told buyers that there is a possibility for way more upside in the near term, not just based on the chart, but because we're already basically at our daily average ATR. Once we got beyond that level, buyers knew that something dynamic was really occurring. And so they started piling in, and boom, next thing you know, another 4-point jump from that moment. This is really important, folks, because if we recognize, once stocks expand beyond that ATR, we know that pricing movement could be very, very significant. Now, what does this actually have to do with the ATR trailing stop? So it was really important that I expanded on that ATR because that ATR gives us an average on what the stock price moves. The ATR trailing stop is actually very different. Some of you probably already know what a trailing stop is, but an ATR trailing stop is a different variable of that. Generally speaking, with trailing stops, there is a specific condition that you have to write in or set it as, meaning stock moves 35 cents, the stop will bump up 35 cents, right? And it's that preconditioned specific pricing, whatever you guys do. Maybe you want to do 1% or 5%. Regardless of what it is, people generally have it automated and they have it same across the board. This is mistake number one, folks. Not every stock trades the same. Even though AMD and NVIDIA will generally move in sympathy, meaning if one's going up, the other's going up. One's going down, the other's going down. The difference between the two is that while AMD may move 35 cents, NVIDIA will probably move $1.50. Yes, the moves are sympathetic. They're very similar, but the amount of price movement is extremely different. Same stock, same sector, but they cannot have the same trailing stop. This is something important that new traders need to recognize. One size does not fit all. The ATR trailing stop plays an integral role in this situation. Because of the ATR trailing stop is actually intuitive. So what I mean by that is that it's actually self-adjusting in accordance to the stock itself in terms of pricing behavior. So what do I mean? Well, the ATR trailing stop in NVIDIA may have a lot more room than the ATR trailing stop in AMD. Again, both stocks are very same, right? They're very much the same. They're in the same sector. They're the same type of business. But the difference is one moves much greater than the other, meaning the volatility in one is much bigger than the other. And because of that, you cannot utilize the same trailing stop. Now, even on a percentage base, which you'd be like, oh, well, what are we doing on a percentage base? That will self-adjust it. It won't. Quite honestly, there will be situations where NVIDIA and AMD may trade totally polar opposite of each other. Again, the stop should be intuitive to how that stock behavior is. Because there could be news, there could be analyst notes, there could be earnings, there could be, I don't know, someone comes out and makes a specific investment in that particular company that can move it much more or cause the stock to tank. Whatever it is, every single stock has their own lifeline. So while they're generally moving in sync with the broad markets, they don't always have to. They always have their own source of news, their own source of trading, their own source of institutional investors and traders that are actively trading that name every single day. And because of the pricing discrepancy, because of the volatility, things may be different. And so that ATR trailing stop is extremely intuitive. It'll recognize if things are not the same, that if volatility does kick up, it will self-adjust and account for that volatility. And that's extremely important in this scenario. Now, I actually call the ATR trailing stop the greatest indicator I have worked with. And yes, a trailing stop is that great indicator. The reason being is that it helps me get on that correct side more and more often than anything else. Now, there's two different variants of using this, all right? As a straight up indicator, it's going to help you get on the correct side more. And number two, it'll also help you recognize when the market sentiment has shifted on that stock. Again, let's take a look here. I am going to erase everything that I wrote. Now, you could actually see here, and I'm going to delete a lot of these. Let's just pull all these off here just really quick, all right? Yeah, we'll just leave it like this. Give it a clearer picture here. Now, what I want you to focus on are these teal and purplish pink dots here. That is your ATR trailing stop, okay? So when the stop is below the market price, or in this instance, if you could see the color, the ATR stop is blue, that means we should be a bull or bull bias. We should be looking up in this situation. We should be looking to buy the dips, play breakout trades, et cetera, et cetera. We should be looking to the upside. That's what the ATR trailing stop is saying. But if you notice here, folks, right in this situation, right where I'm highlighting with that circle, we went from blue to pink. Now the ATR trailing stop is above the market price. This is actually suggesting that we should be a bear on the stock, that we should start speculating that the stock price is going to go down. It's assessing the risk to the upside. So if you are short, your stop is going to be above your entry price. If you are long, your stop is going to be below your entry price. So notice how at that moment we went from blue to pink. Now, if you notice at that moment, that was right around, let's say around $120. Since that shift, it went from $120 down to $73.58. The time frame, about 4 to 5 weeks. Now, if you look at where I'm highlighting with the blue circle, notice where at that moment it went from pink to blue. That was right around the $100 mark. Since that moment, over the next 2.5 months, we've gone from $100, currently now trading at $150, $170, or it basically gained 51.7% since that moment. It's extremely, extremely accurate. Now, it's not 100% accurate. And during extreme volatility, there are chances where it could flip from blue to pink to blue to pink. Now, respectfully, under extreme volatility, anything goes. It's really hard pressed to say that any indicator is going to be wholly 100% reliable in those situations. But you could see, even during the volatility, how fairly accurate this is. Let's actually point out the cues over this situation. Now, you can see the volatility has taken place, but look at the transitions prior to, and look at the pricing movement that took place afterwards. And in this situation here, you can see that the volatility has reigned supreme. It has caused a little bit of a fake out. And you may say, well, I can't rely on it. Listen, guys, come on. If I actually pull this out and give you a broader picture, you'll see how rock solid this is. Now, let's put this on a 2-year time frame. Let's maximize the sell here and expand it a little bit more. So let's start from here. We saw that it flipped down. It ended up working from around 360 down to around 340. We flipped it right around 360, went up to 408, okay? So we had those transitions, smaller downside, bigger upside. Now, if you take a look, going into the start of 22, we actually had flipped. We had flipped, I believe, in late November, early December. From that moment of the quote-unquote Qs flipping, that was near right around let's say around 390. The Qs ended up dropping down as low as $318. On that flip break on the bear market pop, it only ran up for about 20 points. But when it flipped again back here, and that's the reference, once again, the Q slide from 335 all the way down to 268 was very prominent. When it flipped back up again, we went from 310 up to 332 in about 2.5 weeks. And then finally, when we broke down the last time right here, okay, the market went from 303 down to 259. Again, look at how fairly accurate this has been. And look at how sustainable these runs have been. Even in the face of extreme volatility, it certainly has given some really strong guidance. This is extremely important to recognize, because if you are buying during these situations, well, imagine you had this information on your hands that would have told you maybe now isn't the time to be a buyer just yet. Now, certainly we could look for reversal signs. Those are always going to be key to buy off lows. But respectfully, the buy with confidence is when we see these moments turn over. A name that I extremely love has actually showcased weakness for far longer than most people probably anticipated. This is PayPal. If you're not familiar with PayPal, you probably never used any of their services, but most people are familiar with PayPal. So if you actually take a look, going back here, after their all-time high, the stop ended up flipping on July 29th of 2001. It was suggestively saying, start looking to the downside. Again, that had occurred right around $282. Before it ended up flipping, it got down as low as 92.25. Nearly a 200-point runoff. That was till March, from July to March. Now you've seen we've had some transitions here and there, back and forth. That's along with the overall broad markets. The transitions overall have been actually pretty decent, but what was really key in this factor was that initial warning and break off the highs. So if you were an investor on PayPal, or you were a long-term trader on PayPal, and you recognize this, and imagine you were long at $180 or $200 or $250. Imagine the heartache that this indicator would have saved you as this stock was plummeting and losing 2/3 of its value in less than a calendar year. So now you might say, well, is this only good for the daily chart? That's an important fixture here because it's not always going to be important for the daily chart. The beauty of this is that the utility can be used for any time frame. Day traders, if you trade on a 1 minute or 3 minute chart, imagine what's taking place here. Imagine the volatility indication here. Now, it may not be as ongoing and sustainable, but again, if we see that back and forth, swinging back and forth, we obviously know that the market is A, swinging up and down and not giving us direction, meaning it's volatile or choppy, or B, that there's something that's not healthy in regards to the stock. So let me pull up AMD. AMD had earnings here. And what's beautiful is that A, guys and gals, if the stock is trending, well, imagine being able to hold throughout that entire trend. A lot of people sometimes get a little nervous. They let go of money or let go of their positions a little bit too early. And this is a good way of truly knowing when the heck you should get out. This also could help you hold strong. Well, here's a case earlier, pre-earnings, that AMD in pre-market ended up getting that blue stop right there. And if you would have bought in early here, you would have literally held all day long because there was no reason to get out. Let's look at the recent run-up in Tesla here, both up and down. So we have seen the utility in Tesla play in different ways. Tesla, just a few days ago, made a substantial run, basically running from $165 to $180 in one day. Now, knowing your upside targets, that's up to another lesson. But most notably, if you actually look at this, this is Tesla on a 3-minute chart. If you notice, the stop has remained blue. If you recall what I said earlier, when that ATR trailing stop is blue, we should be bull bias. So if you were holding early on in Tesla and we got this run, most people will be like, oh my God, I'm up $4 or $5. Let me take the money and run. Some people will hold strong because they're greedy and they want to maximize it. But for those that need a wake-up call on when to get out, this ATR trailing stop indicator will actually tell you. Okay? And more importantly, this utility works in both directions as well. As you can see, Tesla had one moment the following day, which was on Monday, or the following trading session, which was on Monday, where it was blue. Well, the stop flipped pretty early within the first hour of the day, and then that led to that cascade on down. So imagine if you were short Tesla, how much you could have capitalized. The following day, Tesla went from pink to blue. We basically went from 167 and rode it all the way up to 174. And you could see here right now, Tesla ended up flipping that stop. We ended up working a little bit lower. That stop flipped at 172, got down to 169, and now We are still settled, still slightly bearish in the near term. Notice, folks, that AMD is up. Here's AMD, and they have their blue stop, but Tesla is pink. That's why things, right? Stocks don't trade the same. More importantly, we are accounting for the volatility. We're counting for the actual stock performance. It is self-adjusting. It is intuitive. I gave that comparison about AMD and NVIDIA. So NVIDIA right now is actually projected to move down. AMD still has their blue stop. NVIDIA has turned down. So another key factor here, I want you to take a look. We have double topped here. We have double topped here. We're also making lower highs, and now NVIDIA is working lower. NVIDIA currently is about $2 off of their highs. If we look at AMD, well, they're about 40 cents off of their highs. Again, AMD stop below is blue, still trying to turn up here. NVIDIA stop is pink, trying to work down here. NVIDIA is actually showing weakness. AMD is showing strength. They're very, very similar companies. Generally, they move together almost on a tick-by-tick basis, up and down, usually sympathetic. But now something is happening. NVIDIA is working a little bit lower. The markets are probably working a little bit lower here. Yet AMD is showing strength. AMD is projected up. NVIDIA is projected down. This is a good example of exactly why this stop is so amazing. And it's not just because you could calculate your risk. That's actually the icing on the cake. Remember what I said. This is the greatest indicator I've worked with because it's going to help me get on the correct side of the market for that stock more often than not. Now, it's not 100% guaranteed, of course, but it certainly has that ability of having a high level of accuracy. All right. So now, folks, we got to understand, right, when we defined the benefits of a trailing stop, I broke down what the ATR is, and now we married these together, and I explained why it's so important because they're intuitive. We just got to say 2 plus 2 here. When we talk about things being very straightforward, don't overthink it. If it's blue, we should be bull biased. If it's pink, we should be bear biased, meaning if it's blue, we should be looking to be a buyer. If it's pink, we should be looking to be a seller. Doesn't mean that we automatically jump in. In some situations, we could warrant that. But certainly, this is just one portion of the puzzle. This is a big portion, but ultimately, as traders, especially if you're utilizing a array of indicators within your trading, that's really what an algo is. An algo is taking different data points and looking for that one sweet spot, that high percentage, high percentage of accuracy. We don't want to guess here. Everything in terms of what we teach at Prosper Trading is usually rules-based. These things are there as safeguards. It's because we have a high level of accuracy when the stars align. And when we expand beyond those levels, where we're opening up a different can of worms, we're not taking the same context. And ultimately, it just becomes more guessing. Certainly, trading always has elements of speculation. That's exactly what trading is. But if we break it down to the core, us as traders, especially people that are using chart patterns or using indicators, there is a rhyme and a reason of why we want to get in. None of which is going to be, I want to buy, so I'm going to buy. I want to buy, but I need to qualify my buy. One of the questions you may be asking yourself is, what is the ATR trailing stop doing now? What color is that ATR trailing stop? Is it blue or is it pink? Well, if the market is moving up, we have that ATR blue, we get your other indicators that are suggestively saying bullish, and now it's actually created a buy side opportunity, an actual signal where you can define your entry and your risk. Well, you're left with one thing. You either pull the trigger or you don't. It's a great situation to be in as a trader. Trading with clarity, trading with structure, trading with the odds in your favor. Some people may say it's guesswork. I don't. I like to say is that we are trading with the odds in our favor. Calculated risk, I guess you want to call it. Truth be told, we are seeing a historical average replay over and over. And the probabilities that came from that historical average is what we are utilizing in that situation to either be successful as a trader or not being successful. Obviously, we want to be successful. So let's swing those odds in our favor. So folks, if you like what you heard, do me a favor, like, comment, and subscribe. Click on that notification bell. When you comment, let me know if you want to hear about certain indicators or if you want to hear about certain stocks. We'll be more than happy to kind of break down in these videos in the future. Ladies and gentlemen, peace and love, and see you soon.